In this video, we're going to talk about a really crucial thing in day trading. I think, in my opinion, other than the psychology, this is the most important part. Actually, the psychology is going to affect the way you're going to manage your risk. So the more that your psychology is really dialed in, the better risk management you're going to be able to have. So in this presentation, we're going to talk about risk per trade versus your account size. Then I'm going to share with you a growth plan. So what kind of growth plan I personally use to start building up my account without, and not without, but trying to avoid some big mistakes. Then stop loss placement. So there's multiple kind of way to place your stop loss, and I'm going to share that with you. Then take profit strategy. So there's, again, different kind of way you can decide to scale out of a trade. I don't know if there's one that is better than the other, but I'm going to share with you different kind of strategies there that I experiment myself. And at the end, I'm going to share with you some examples of some well-managed trade versus poorly managed trade that I personally taken in the past. So let's jump right into it with risk per trade versus the account size. So day trading isn't about how much money you make, it's about how much you protect your account, how much you protect your capital. So your risk per trade is the foundation of your survival. This part is really important because if you risk too much, you will blow up quickly, no matter how good your strategy is. So maintaining your account in day trading is the most crucial thing. So here's a bunch of rules that I really recommend every trader stick to. The first one is never risk more than 1 to 2% of your account per trade. So let's say you have a $10,000 account. That means that your max risk per trade should never be more than $200 per trade if you want to protect your capital. If you have a 10K account and you start to risk $1,000 per trade, let's say this is 10% of your account, well, you're just 10 trades away to blow out your account. So you need to be really careful here. And the goal is in the long term, not trying to get rich quick here. Max 4 losing trade per day. So for me personally, if I lose 4 trades in a row, I have a rule that I will close my Dash Trader Pro and I will call it a day. So basically, I enter the day. Let's say you have a $10,000 account. You know that your max risk per trade is $200 and you can lose 4 trades in that day. So the moment you start trading, you know that the worst scenario, the worst case scenario that could happen to you is you lose $800, which is not that bad. So you're mentally prepared that the worst case scenario is $800 and you're already comfortable with it. It's like you're willing to pay $800 to see if you're going to make money that day. That's just how the game is. So switching your mindset to that will definitely help you to be less emotional and to manage your risk better. So always risk the same amount of money per trade, for me, is a game changer. And I use, like we saw together, some script with Dash Trader Pro that are really helping me for that. So I don't even need to calculate the amount of money I need to put in the trade. All I know is that I'm risking this specific amount of money. Always aim to make minimum twice your risk. So here in this video, you're going to hear me talk a lot about the R ratio. And R stands for risk. And I calculate everything in terms of R. So I'm not really thinking about how much money I made today. I'm more thinking about how many R, so how many times my risk I made today. So for the sake of that example, let's say you risk $100 per trade and you take 10 trades in total on, let's say, a full week of trading. Well, if you always aim to make minimum twice your risk, that means that you only need to win 4 trades out of those 10 trades to be profitable. So if we look at the example I marked down on the slide here. So you lose the first trade. Then the second trade is a win. After that, you lose 4 trades in a row. Well, losing 4 trades in a row here, you will probably get really emotional here. You will probably start doubting your system. But if you stick to your strategy and keep waiting for at least 2 hours in profit to take your to start to get out of the position, well, here's how it get interesting. Let's say trade 7 was a winning trade. Trade 8, another winning trade. Trade 9, you lost it, and then trade 10, you made another $200. So out of those 10 trades, you win 4 and you end up with a total profit of $200. So for your system to be profitable with a 2R risk per trade, you need to make you need to have a 40% win rate and you're profitable. So you can lose 60% of the time and you still have a profitable system. And that's the beauty of trading when you're able to hold to your winners and cut your loser quickly. Really important. Now I want to share with you my growth plan strategy. So what kind of growth plan I use since I started trading to slowly build my trading account to what it is today. And I'm going to share with you all the rules I stick with here. The first one is start small. Really important. So when you're beginning, your number one goal in day trading is not to get rich. That's just not going to happen. The only way it's going to happen is if you get really lucky, and that's not sustainable in the long run. And the goal here is really to build consistency. You want to build a profession here. So it's like becoming a doctor or engineer. You need to study and practice for years. Well, it's no different with day trading. To get that consistency, you need to be patient, take it small, and go step by step. So that means starting with small risks so mistakes won't hurt your account. And even that, before that, I will say start practicing on a fake account with fake money. Build your system. When you feel comfortable that you have a system that works, then you can jump with real money with a really small amount. You don't want to get too emotional and have bad mistake that will keep you out of the game forever. That's really important here. Being patient. So small risk lets you focus on execution and psychology, not on P&L swings. What I mean by P&L is profit and loss. So what kind of profits you're making. Then the second thing, measure growth in R, not dollars. So that's what I was talking about before. Everything should be in terms of R, not the amount of money you made. Because no matter how much you're risking, the R ratio is never going to change. So if I risk $1,000 per trade, I end up making 5,000 in a day. Well, I made 5R. If I'm risking $10 on a trade and I made $50 on that day, well, still I made the same amount of R, 5R. So it's the same kind of success here, just different scale. But the scale is what you're going to come slowly with practice and confidence. But starting small is the most important thing. So R stands for risk unit. So if you risk $100 per trade, then your 1R is a $100 gain. Minus 1R, well, that's a risk, so you lost $100. So by tracking R instead of dollars, you measure your skill in consistency, not your bank balance. And that will leave you with a lot less emotions. Trust me with that one. Then third, rule of scaling. So this is a rule I've been sticking to since the beginning. Now it's been a while since I increased my risk, but when I started trading and I wanted to slowly build my account, that's a rule I was using. So only increase risk after proving consistency. My rule here, at least 3 consecutive months with a minimum of 20R in profit. That means that you've shown discipline, risk control, and the ability to stick to your system over time. So let's say, well, when I started trading, I started really small. I started with $50 risk per trade. That's all I was risking here. So I needed to wait to see at least 3 months in a row with 20R in profit. That's telling me that first, my strategy is working. Second, I'm able to apply that strategy and manage my risk correctly. If I've spent 3 months consistent with that, well, I'm confident enough to increase my risk. And again, I need to go slowly here. So after that, I jumped to $100 per trade risk, waited for another 3 months of consistent results. Then I jumped from $100 to $200. And then I jumped slowly to $200 to $500 to $1,000. And then I just go slowly like that. But at the end, nothing changed. The way I was trading at $50 a trade is the same way I trade at $1,000 a trade. It's the same system, it's the same strategy, it's the same risk management. It's just the amount of money that changed. But in terms of R, everything is the same. So that's a rule I have for scaling if you really want to protect your account. It's tempting to go fast here, but I really recommend you keep it slowly. It's not a race, it's a marathon, and trading is something that you need patience. If you don't have patience in trading, you're just going to end up blowing your account. So that's my recommendation here. So far we've been talking a lot about what we're risking on a trade. But risk will always come with a stop loss. So the stop loss is basically what protects you. It's your safety net. It's not about being wrong. It's about defining how much wrong you can afford. So without a stop loss, one bad trade can wipe out weeks of progress. And actually, personally, all of my mistakes I did in day trading always come to a situation when I remove my stop loss. So I enter a trade with a stop loss, I don't accept it, remove the stop loss, start adding to the position, and this end up in a big loss. So stop loss is the most important thing to respect in terms of risk management. So there's two main categories of stop loss. You either have a hard stop or a mental stop. Personally, I use hard stop. I've been using hard stop since I started trading, and I swear by hard stop, this is for me the most important thing to have. It's really helping me to protect big losses. Mental stop for me, I think, will be really dangerous for some people. They trade really nicely with mental stop, but you need to have a really, really solid discipline for that. What is the difference between the two? So hard stop means that the moment you enter the trade, you have an order placed in the market that if the trade don't go in your direction, you're gonna get stopped out automatically. So this is safety net, is protecting you. So if we look at the screenshot on NVDA here, so the triangle we see here, the red one, is where I enter. So I enter to the short side. The moment I enter that trade, my stop loss was placed below the VWAP. So like we saw in Dash Trader Pro, before I enter the trade, I double click where my stop loss will be. So even before I enter the trade, I know where I will exit if the trade don't go in my direction. So I'm prepared. So in that example, the trade worked, but let's say that the trade didn't work here. So the price would have moved higher and reach over that level. Well, automatically I would have been stopped out of the trade. So that is a hard stop. If I would have used a mental stop on that trade, that means I would have entered in the same spot. I would have mentally told myself that if the price goes above the VWAP here, I will need to get out of the trade. But that means that if the price decides to go up over the VWAP, I need to manually click on the chart and get out of the trade. But think about it here. When the price start to go up here, slowly approach the VWAP, I'm getting emotional here. I might feel frustrated. I might feel mad that the trade is not going in my direction. I might be scared here. I might feel a bunch of different kind of emotions that could affect what kind of move I'm gonna do next. So if I'm really emotional, I don't accept the loss. Well, I might say I'm gonna give it a couple more cents, $1 more. Let's see if my stop loss was here in the beginning mentally. Let's say I'm gonna wait for high of the day here. Well, what could have been a $100 loss here, by waiting here, could turn into a $300 loss, and that will hurt you in the long run, definitely. So that's why I think mental stop is tricky. Like, you really need to be disciplined that if it reach over where you should get out, you get out manually. Compared to a hard stop, well, I know that if it don't go in my direction, I already have an order there that the market is going to take me out automatically, and that's protecting me. So for me, that is really important because there's so many different situations in trading when you will get really emotional. Let me give you a clear one here that I see happen many times. So let's say same situation. You enter short here. You see the price, and this is your target, by the way. So this is where I went out for the first time with a couple of shares off the trade. So let's say you're in the trade short here. You see the price going in a direction, but didn't quite made it to your first target, which was right here. Went really, really close. And then you see the price reverse on you here. And let's say your stop loss mentally was still around here. And let's say you see the price go back, go back, go back, go back, and hit it here. But you need to manually get out of the trade. And you saw yourself in profit super close to your target. And now what was positive emotions like excitement, euphoria, turned into frustration. Well, here what you're going to do. Are you going to be able to manually get out of the trade? Well, if you do 100% of the time, you're a really good trader. I don't know how you're doing. Personally, I wouldn't be able, and that's why I will use always hard stop. So this is a kind of situation that you will see and face many times in day trading. Here's the common mistakes I see and experience myself many times. The first one is placing your stop loss too tight. So normal noise takes you out of the trade. What I mean by that, if we go back to the chart, my strategy, like if you already saw the video, which is the opening range break and retest, my stop loss is above the VWAP. Let's say in that trade, I would have placed my stop loss just a little bit under the VWAP. Well, many times that will cost me a trade because the price will just tap it, get me out of the trade, touch the VWAP, and poof, move in my direction. So this is a common mistake. You need to give some room to your trade to breathe and don't place your stop loss too tight from your entry price. Then placing stop loss randomly, no relation to the chart. That's a recipe for disaster as well. You have a strategy, you have fixed rules, you need to always have your stop loss using the same rules. That's super important if you want to have a consistent system. Then moving stops further away after the entry. That will turn small loss into big loss. So this one really important. Like I talked about, most of my big mistakes comes from that, either removing my stop loss to give it more room because I don't accept that I'm wrong, or completely removing your stops. That can hurt you a lot. Then the psychology of stops. So think of your stops as a tuition. It's basically the cost of learning whether your trade idea will work or not. So let's say your risk per trade is $100. Tell yourself that, okay, I see my pattern happening. I'm willing to pay $100 to see if I will be right or wrong. So the moment you enter the trade, you already prepare that you lose that $100. The best case scenario, you're gonna make money, but you're prepared to pay that tuition to see if you're gonna be right or wrong. Switching that mentality is really gonna help you digest losses better, and that's super important. So small control losses are the price you pay to stay in the game long enough for the winners to pay you back. And lastly, move your stop loss to break even after a partial is another rule I have and that I really recommend. So let's say you enter a trade. Let's go back to the screenshot. So you enter the trade here. This is my stop loss right here. So this is my risk of $100. And then I need to wait for at least 2 hours to take my first partial. So here I'm already $200 in profit, and then I scale out of the trade. The moment I take that partial here, my stop loss that was originally here will move to my break even right here. So this is to protect my gain. So the moment I partial of the trade here, that trade that is a winning trade now is never going to turn into a loser. And that's going to help you emotionally as well. So this is a rule I have since I started trading that I always stick to and that I think is really important as well. So hopefully by now you understand the concept of R, so risk to reward. Now you know exactly how stop loss works, how to protect your capital. Now it's going to bring you to another really important part of day trading, well, how you want to take profit. So if the trade actually goes in your direction, how you cash in those profits. So why the risk to reward matters. So risk to reward means how much you make compared to how much you risk. So example, like we talked about, if you risk $100, if your target is $200, well, that's 2 hours of profit. To be consistently profitable, you need winners that are bigger than your losers. And we saw why together. Now there's multiple strategies that I've experimented in the past of how to get out of the trade. It's really hard for me to tell you if there's one that is better than the other. I have no idea. It really depends of your style of trading. I think it's worth to experiment all of those and see which one you feel the most comfortable with. It's something I'm constantly changing with my trading, trying to optimize it, but I haven't really found the perfect recipe for it. So I'm going to share with you all of those different kind of strategies. There's 4 here. The first one is scaling out of the trade, and this is the one I currently like to use, depending on the strategy, of course. So what I mean by scaling out of the trade, that means that if the price goes to 2R, I will partial 25% of my original position. Then if it keeps going in my direction, I will take another 25% off of the remaining position at 3R and keep going like that to 4R. And you can have final exit at 5R or just let the trade and the remaining of the position go to see if there's more either downside or upside of the trade. This one on Dash Trader Pro, like we saw together, you can use the hotkeys to scale out of the trade. Really straightforward, really easily. And the moment you scale out, the stop loss will be placed automatically at break even to protect you. So this is a really popular way of scaling out of taking profit, scaling out of the trade. Then all out at target. That's another interesting way to trade that I really like for reversals. So exit 100% at 3R or a chosen level. You can wait for 4R depending of your strategy, of course. So that means that you have one entry, one exit. That's it. Then partial plus support and resistance level. So that's another way I really like to trade as well. So you take your first partial at 2R, let's say 25% off of your position. Then you will scale out at major support and resistance levels. Could be at the Carmela pivot point levels like we saw together. So let's say you're long at S3, well, you partial at 2R and then you wait for R3 to take more off of your position, and then R4 to take even more off of your position. That could be a really interesting way to scale out of a position. Then another one you can use is partial plus trailing stop. So this trailing thing is to protect your gains. So first partial at 2R, then trail the remaining of your position. So you can trail with two different ways. You can trail by 5-minute high and lows. So it's a dynamic short-term structure. So let's say you're short on Tesla. Tesla goes down in your direction, you partial at 2R, and then you look at the 5-minute chart and you move your stop loss slowly closer to the price using a 5-minute high. So if the price make another 5-minute high, you're out of the trade automatically and it's going to protect the remaining of your gain. Or another way you can do it is by trailing the 50 moving average. So this is a trend continuation anchor. So you have your moving average on the chart. If you see the price going over that 50 moving average when you're short, you're going to cut the remaining of your position. So those are two ways you can trail your stop that are really interesting. Now let's see some examples of some well-managed trade versus some poorly managed trade. The first example here is on AMD. So let's look at what happened emotionally behind the chart here. So I entered to the short side here with a really nice setup. All my criteria were respected, really beautiful entry right on the opening range. At that moment, I placed my stop loss over the VWAP. So what happened here? So the price started moving in my direction. So I got excited here. Then it just pulled back and went super, super close to my stop loss. After that, I saw the price moving back down here, trying to go back to my stop loss here. So I was definitely on edge here, seeing the price choppy and not going in my direction until it finally did here. But it never quite made it to my 2R target, so I haven't partial because I need to wait for at least 2R for my system to be profitable. So there I was definitely excited here. I was feeling some euphoria because I was seeing the price getting close to my target, which in my opinion was probably around here. So this was my risk, so about 2R, so I was pretty close to 2R here. And then I saw the price reverse back here over the VWAP and stop me out. Here when it got close to my original stop loss, I was probably really emotional here because I got so close to have a profitable trade that now turned into a loser. So seeing some green profit turning into red, it's something really hard to manage in day trading. But here I respected my rule, respected my stop loss. I had good risk management, got out of the trade and moved to the next one. So this is definitely a well-managed trade, and this is the kind of loss I want to have. Here's another well-managed trade. So I took the opening range break and retest here, right at the VWAP. My stop loss was probably around here. Took my first partial at 2R, took more at this specific level I was having here. And then the price reversed on me and I got out at break even. So really important to get out at break even, because let's say I got emotional here, I would have guessed that I wanted the price to go back down lower. But it's possible that the price just start moving higher and higher and higher here. And that trade that was a winning trade here could have turned into a losing trade here. So that's why I cut it at break even. So another well-managed trade because I respected my rule. Here's a trade that worked, that I made money, but I really consider it as a poorly managed trade. What do you guys think? Why is that trade not well managed? Well, that's because I took way too many partials. So my entry was good. My stop loss was probably around here. I saw the price moving in my direction. So first mistakes here. So this was my risk. So this was 1R here. And I didn't wait for 2R of profit here. So I partial before 2R. So probably my stop loss was even a little bit below, probably below the 50 moving average, because I like to do that often. So my stop was probably here. My entry was here. So my 2R should be more around here. And I partial at 1R here. So emotional here. I saw some profit. Maybe I got scared that the price will reverse on me and I want to secure some profit. That's a mistake, because if I trade that way all the time, my system is not going to be profitable in the long run. And then why did I take another partial that quickly here? Again, emotions. When I see that chart, the first thing that jumped into my eyes is that this trade was emotional. I got super emotional. And then I take another one here, another one here, another one here. Now, the way I should have traded on that on this one, I should have waited for here for my first partial. I should have taken more at close to 319 here. And then I should have waited here on the pullback. And that's a third mistake by looking at the chart here. I got 100% out right here. Well, this is not my break even. My break even was here. And the price never quite made it to my break even and bounced here. I'm not sure what happened after that, but imagine if the price would have keep going and make another high of the day. And I'm all out of the position. You need to wait for your break even. If not, you stay in the trade. Really important. So those are a bunch of emotional mistake that I did on that trade. It was poorly managed, even though it turned out into a profit. Profit doesn't mean that your trade is well managed. I prefer having a trade like this one here, which is well managed, but I'm taking a loss, than this one here that is poorly managed, but end up with a profit. So profit doesn't mean nothing. The important thing in day trading is always the execution, not how much money you're making.